According to GAAP, assets are recorded in the books at their historical cost. In other words, the amount that the company actually paid for them when they purchased those assets. This may seem obvious at first, but there are times where it would be tempting and seem reasonable for a company to report an asset at a value other than the amount that they paid for it. For example, if the company has owned a piece of real estate for a number of decades, reporting the value of that land at its historical cost, the cost that it was purchased for several decades ago, may very significantly understate the value of that land. However, if GAAP allowed companies to use any other valuation method other than historic cost, it could introduce a great deal of subjectivity into the process. Depending on who you ask, you could get several different estimations for the fair value or the current market value of that same piece of land. Instead, GAAP usually requires that companies report assets using the most objective value, the cost paid for them. The cost was a real amount of money that was really paid in a transaction for that land, whereas the fair market value is speculative and can introduce bias. An interesting note concerning the real estate example, in almost any city or town, a piece of land would increase in value over the course of several decades, and so it really seems reasonable to go with some form of fair market value when recording this asset. Let's say the company bought the land in the 1970s for $50,000, and that in today's market, it would likely sell for 3 times that amount at $150,000. So it looks like we're leaving $100,000 off the books just to satisfy this principle. You need to realize, however, that the company is preparing financial reports for external users, and external users are okay with being under-promised and then over-delivered to. A company will do well if it sets everyone's expectations low, then exceeds them. This follows the conservative approach that accountants are expected to adhere to.